Welcome back, everyone, to FX Street. It's 8 a.m. Eastern. Today is Thursday, May 27th, 2010. Welcome back, one and all. Great that you could join us. My name is Adam Rosen. Very happy to be here. We're going to spend the next 45 minutes to hour or so talking about a very, very big number that we expect to be released within the next 30 minutes, now 29 minutes. The US GDP number, and it is a very big number. It can certainly be a market-moving event, and that's why we want to host a special webinar to discuss the impact of this number as it stands in terms of our fundamental analysis, how we gauge the strength or weakness of the U.S. economy, and certainly what impact this number can have to our long-term and short-term trading strategy. So we're waiting for the release of the number. Again, it's expected at 8:30 a.m. Eastern. It's about 8:01 a.m. Eastern. We have 29 minutes to go. In the interim, though, what we're going to do is we're going to try to discover what this number means from a fundamental and technical point of view. If you have any questions, comments, concerns at any time, please feel free to type them in, and I'll be more than happy to get to all of them. However, without further ado, we're going to get started. Now, we're taking a look at the Dow Jones Industrial Average chart. It's the futures chart. The symbol is YM. 10,103. We can see the futures are quite strong today, almost at the highs. The highs today of 10,148. We've seen a dramatic pullback in really a downturn in the equity markets over the past month or so. Dow Jones Industrial Average futures did trade at highs of 11,201. Going back to April 26th, but we're certainly well below that. Now, very important to note, we're at a critical point, and usually the release of these big economic events typically take place at important turning points in the chart. So I think it's important to identify these levels before the number is released. And what we're going to do also is we're going to track this GDP release, the gross domestic product, and we're going to try to plot our 15-minute cooling off period strategy, which is a nice short-term day trading strategy that we can apply to big numbers like non-farm payroll, CPI, the Tankin out of Japan, etc. GDP certainly does qualify. The lowest lows we've seen in quite a long time occurred 2 days ago. The long candlestick wick came down to 97.53. This was on May 25th. 97.53 came very close. Actually went a little bit lower than the former lows of 97.87 on February 5th. That is big because if we zoom out on the daily chart, we can see that 2 days ago, we barely traded at levels, at least on a futures basis, that we had not seen since November of 2009. Imagine all those traders who sold short the market 2009, from November 2009 until 2 days ago. At that moment, they were all making money. All of us that bought the Dow Jones Industrial Average between November of 2009 and 2 days ago, we were all losing money. Now, the market did eventually recover. However, when we trade at new 1 year highs or lows or even more significant periods of time, it certainly is important. So, if we see the market break back below 97.50 on the Dow Jones Industrial Average, futures or cash basis, I certainly would expect it to maybe be conducive for a further move to the downside. Now, more importantly, not more importantly, but equally importantly, take a look at the low of 98.63 on May the 6th. May the 6th should ring a bell because that was about 3 weeks ago when the Dow Jones Industrial Average had that dramatic trading range, about 1,000-point trading range from high to low. We ended up closing down only a couple hundred points that day. However, we did see a very large trading range, and technically that was a big event. So, if we break below 97.50 on the Dow Jones Industrial Average, I certainly would expect us to continue lower, lower, lower. Now, what does this pattern look like before we get to the fundamental point, type of the fundamental side of the story? This, to me, is starting to shape up to what could be a massive head and shoulders pattern. Take a look at the first highs, the first shoulder highs, I should say, 10,681, that's the futures highs, January 19th of this year. January 19th, I think, could be the first shoulder. The head is at the top. The head is 11,201, and that occurred on April 26th of this year. Now, the rule of thumb is the second shoulder should come very close to the high of the first shoulder. What we're expecting is the Dow Jones Industrial Average, if we believe that this is, in fact, a pattern. I kind of do. I think we're going to see the Dow rally. I think we're going to see a lot of optimism return to the market. Maybe the GDP numbers will be good today. and we'll see the Dow rally. But I find it very hard to believe, and I don't enjoy being a pessimist, but however, if we expect this pattern really to hold true, I do not expect the Dow Jones Industrial Average to cross and close above Dow 10,700. Why? Because the first shoulder high was 10,681, rounded up to the next large round figure. 10,681 is very close to 10,700. We may go a little bit above 10,700, but take a look at the closing price. Now, when that is referred to as the neckline of a head and shoulders. If you can imagine, the head is at the top. The first shoulder is on the left-hand side. Second shoulder, rule of thumb, is usually comes in very, very close to the high of the first shoulder. High of the first shoulder fell just shy of 10.7. The second shoulder could be also 10.7, give or take a few points. That is the neckline of the head and shoulders. We also have a shoulder line, and that is below. The shoulder line are the lowest lows that the market was able to achieve while we established its head and shoulders. The lowest lows, remember we talked about 97.87 on February 5th? Well, 2 days ago, we hit lows 97.53. Considering it's a daily chart, considering these are the futures in the Dow Jones Industrial Average, that's pretty close. Round it on down to the next large round, big figure, 9,700. So essentially, I anticipate a trading range now to develop. Month of June is a usually pretty quiet market. I expect the trading range to emerge between 97 to 10.7. It's a nice, very, very healthy, what is that? A 1,000 point range. 97 to 10.7. If we close especially a few candlesticks below 9,700, we certainly could go a lot lower. If we close above 10,700, I think it's a foregone conclusion we're going to try to retest our highs of 11,200 and maybe go higher. Now that's the opinion. However, if I believe the Dow is going to go down, do I want to sell short on the break below 97? I don't think so. That's too late. I think that's not a good spot to sell short at 96.50 because what happens if the Dow rallies? We're going to get stopped out or we're going to take a tremendous loss. Should I buy at 10,800? I don't want to either. Because even if the market goes up, it's going to be scary owning the Dow all the way up here. If I think the Dow is going to go up, why not buy it lower down? If I think the Dow is going to go down, why not sell short higher up? So in other words, let's take my opinion. I think the Dow is going to go down. I think we're going to rally back up to 10,700. We're going to find some kind of resistance. It's kind of hard to say. This is an approximation. But I think we're going to find some kind of resistance, and then we're going to turn back to the downside and eventually break. If that is the case, I want to sell short. My target to sell short is when the market tests, fails to break above the head and shoulders pattern, and then shows signs of reversal back to the downside the same way the first shoulder made that turn. It looks a lot like the Dow Jones Industrial Average did when we hit all-time highs of 14,000. I'll show you that in just a moment. However, if I think that the market's going to go down and eventually break 9,700, then I want to sell short when the market tests and fails to break above 10,700, placing my stops above 10.7, above the swing highs, maybe 10,800, roughly. Question is, second shoulder will be a retest of the broken trend. Yes, absolutely. Oh, yeah, that's actually a very good point. I'm glad you brought it up. I see what you mean. Drawn up trending trend line. A few different ways we can draw it. Take a look at this. Ava, you're a smart cookie. You're exactly right. Take a look at the former support line, new resistance. Former floor, obviously, or oftentimes becomes our new ceiling. That is a very, very important thing to recognize as well. It's a very good point, by the way. So again, if I want to sell short, I want to wait for the market to test and fail to break above our neckline, and as we've also pointed out, as Ava pointed out, also our former support now becoming new resistance. For those of you that are Fibonacci fans, this also makes sense in terms of Fibonacci. I'll show you why. Assuming this is a downtrend, take a Fibonacci line, draw from the highest high, draw it on down to the lowest low. Take a look what emerges. What emerges is 10,700 neckline, our uptrending former support, maybe new resistance, and almost exactly the 61.8% Fibonacci retracement level. That is important. So a lot of different levels telling us 10.7 is big. If we go now, I would like to see the Dow go up. I'm not rooting for the economy to go down. However, we're just interpreting simply what the chart tells us. Unless we break above 10.7, and we break above 10.7 sometime soon, then I think that the chances are probably going to go lower. Now, if you disagree with me, and certainly always is the case that I could be wrong, happens from time to time. If I think the Dow is going to go up, if I'm an optimist, if the GDP numbers that are scheduled to be released in 20 minutes are better than expected, employment gets better, inflation continues to increase, then I think the Dow goes up. Well, I don't want to buy 10.8. I want to buy as close as possible to our shoulder line. It's still a double bottom. Even if this is not a head and shoulders, it's still a double bottom. I want to make sure the Dow Jones Industrial Average does not go below 9,700. Now, how does this help us? Because we're foreign exchange traders. Well, I'm sure you've noticed there's a rather strong correlation that tends to occur between the Dow Jones Industrial Average, other stock markets like the Nasdaq, S&P, etc., and our yen crosses, like the euro yen, the pound yen, the CAD yen, Aussie yen, Kiwi yen, etc., not including the dollar yen, excuse me, for a number of different reasons. But you take the Japanese yen, you put it against most other currencies, you're going to find a rather strong relationship. Taking a look at, excuse me, the euro yen. Now, there's not an exact relationship because what we're looking for is a correlation between one stock market and two currencies put against each other. Euro yen maybe is a bad example because we've seen such unusual absolute weakness in the Eurozone lately, in part due to the really bad debt problems in Greece. However, take a look at the CAD yen. Not a perfect sign. Take a look at the highs of the CAD yen. Going back to the middle of April, we saw the head. What does this look like? This looks like the first shoulder. This is January of 2010, January 7th to be exact. So the neckline, which I think is the top of the first shoulder and what could be the top of the second shoulder, is right around the 90 figure for the CAD yen. I think if the Dow rallies, hey, take a look at this. The CAD yen's also rallying. We're going back up. So it's important to see if and when the Dow eventually goes back up to our neckline, what we want to do is to see if other yen crosses, or if yen crosses have also gone up. Some will move ahead of the Dow. Some will move a little bit behind the Dow. If the Dow breaks above and goes to new highs, some of the yen crosses will move first. Some of them will lag. And that really can, play an important role. Question is, where do you see the euro dollar from the current levels after the GDP numbers? It's an excellent question, Cesar. Let's talk about the euro dollar. We know the euro has been extremely weak lately because the very unfortunate problems that we've seen in Greece in regards to the debt crisis, it's speculated that may continue to other areas in Western Europe, such as Spain, Portugal, and other areas, other nations in that region. The euro has had an extreme amount of weakness. Lately, let's go to the euro dollar chart, by the way. Lately, the dollar has been very strong. Now, with that said, let's talk about the GDP. The GDP number, expected 8:30 a.m. Eastern, has the most direct effect to the US dollar. If the GDP number is stronger or better than expected, what we would expect is that is a sign of the economy that is improving. Now, there's two areas of the economy we have to consider. We have to consider growth, like the gross domestic product. That's GDP. That's what we expect today. And that also includes employment numbers, initial jobless claims, etc. And we also have to take into consideration inflationary pressures. How expensive are things getting? For the inflation, we talk about CPI, Consumer Price Index, and PPI, Producer Price Index. If inflation rises, if things get more expensive, because we all have jobs, we all get bigger bonuses, we're all making more money, we spend more money, prices go up, that's a sign of a strong economy. If the gross domestic product, which is a measurement of all the goods and services produced within this country, within the U.S., if that continues to rise, if it rises today, that's a sign the economy will grow. Well, what happens? Then the Federal Reserve, the FOMC, they start to get nervous and say, uh-oh, the economy's on fire, inflation is starting to rise, let's raise interest rates. Let's cool the economy down a little bit. Interest rates are very, very low right now. They're 0 to 0.25%, 0.25% at most in the U.S. Remember, after the dot-com bubble crash in 2001, 2002, 2003, 2003, the Federal Reserve took rates down to 1%. And a lot of analysts blame the Federal Reserve for keeping rates too low, too long, that eventually led to our housing bubble that burst. I don't happen to subscribe to that. I think low interest rates certainly did stimulate the housing economy, but we can't blame everything on the Fed. At any rate, whether we blame the Fed or not, the fact of the matter is low interest rates like we have now makes an economy strong. As if, to answer your question, if the GDP number is better than expected and a real nice surprise to the upside, I would expect the market, meaning you and I and everyone involved, would start to say, hey, U.S. economy is strong. Well, I want to see the unemployment rate go down, and I want to see inflation go up, but the GDP, if that's good, hey, I think the Federal Reserve may raise rates maybe before the end of the year. Maybe we'll see some strength in the U.S. dollar. If the number is a little bit of a disappointment, or if it's in line, I don't know, maybe you're not going to see a lot of movement. If the number is a huge disappointment, and the expectation is, I believe, 3.5% is the expectation for GDP today. If the number is grossly under the estimate, and it's a real disappointment, and the Dow Jones Industrial Average future spiked to the downside, well, then capital is going to run out of high-yielding currencies like the Aussie and the Kiwi, because it means we're all in trouble. If the U.S. economy is in trouble, it's probably going to affect Europe, which in turn will affect the U.K., etc. So, with that said, a huge disappointment, I think, would lead capital out of Aussie. We're going to sell the high yield, meaning high risk currencies like Aussie and Kiwi, and buy lower yielding currencies. But ironically, the U.S. dollar is a low yielding currency. So the fact of the matter is, you might see some strength in the U.S. dollar, not because the number's bad, but because capital is selling, meaning traders are selling Aussies and Kiwis and everything else. I want to get to all the questions, which I promise I will. However, I do not want to forget one point that I mentioned before. We talked about the very strong correlation that occurs between the Dow Jones Industrial Average and yen crosses. Why is that? Why is it that the CAD yen chart looks so similar to the Aussie yen chart, a little bit different, to the Kiwi yen, another head and shoulders there, to the Dow Jones Industrial Average? Well, we know why the Aussie yen and the Kiwi yen look similar, and the Kiwi yen to the CAD yen look similar, but why do they look similar to the Dow Jones Industrial Average stock market? Well, the U.S. is a capital-intensive type of nation, meaning the U.S. economy benefits from capital investment, from foreign investment. Okay, so when the economy looks good, when there looks like to be a promise, foreign capital likes to come into the U.S. to invest in U.S. companies, maybe the U.S. stock market, U.S. real estate, you name it. Let's buy something in America if we think that we're going to make some money on it. Now when that happens, when we buy U.S. real estate or U.S. stocks, we have to convert our own currency into U.S. dollars. So we have to sell our euros and sell our British pounds and buy U.S. dollars. You can't buy, Microsoft stock with British pounds in the New York Stock Exchange. You have to convert into U.S. dollars. That's why the dollar goes up. But when the dollar goes up, we also see the yen goes down. And we look at the dollar yen, which in the past it had a very strong correlation. A lot of this foreign investment comes from Japan, because Japan's economy is not a capital investment type of economy. It's an export-driven economy, because most of the goods or services, the majority of the GDP that's produced in Japan is done through exports. We don't see so much capital moving into Japan to invest in Japanese. Certainly that does take place, but we think about the automakers and all the other really the fantastic goods and services that come out of Japan. Low interest rates benefit Japan. So Bank of Japan keeps interest rates low, and therefore, when the stock market and the U.S. economy looks promising, a lot of foreign investment will come out of Japan. They'll sell their yen, buy U.S. dollars, or if the U.S. economy looks promising, maybe they'll sell their yen and buy euros or buy British pounds to invest in other capital investment type of nations, like the Eurozone, for example, like the UK, for example. And that's why there's such strong correlation. That's why there's an opposite correlation between the Japanese yen, the actual currency, and the Dow Jones Industrial Average. Now, can you give some input on the current strength of Aussie versus dollar? Aussie, let's check the time, by the way. It's 8:20 a.m. Eastern. We have less than 10 minutes to go. Now, when we think about the foreign exchange market, here's the Aussie dollar chart. I'm going to zoom out to get a good picture of what we're looking at here. When we talk about foreign exchange on a pure basis, we have to consider these currencies in terms of their inherent interest rate. Interest rates are the reason why, on a grand scale, we buy currencies. After all, we have what? Where's interest rates in the U.S. right now? 0 to 0.25%. In the Eurozone, 0.5%. In the UK, at 1%. In Australia, they're higher. Australia is what? 3.5%, if I'm not mistaken? Actually, let's verify. I'll show you what I mean. I'll show you interest rates right now that we're on the subject here. These are, I prepared a couple of really fun charts. These are current interest rates for the different currencies that we follow. The white line, FOMC, Federal Open Market Committee in the U.S. The light baby blue line is the ECB, European Central Bank. The orange line, a little bit hard to see, that's the Bank of England. Swiss National Bank is the violet line. The dark blue line is the Reserve Bank of Australia, central bank in Australia. The red line, Reserve Bank of New Zealand. Bank of Canada is the green line, and the Bank of Japan is the yellow line. We can see Reserve Bank of Australia has the highest rate, 4.5%, after bottoming out at 3%. Reserve Bank of New Zealand, the Kiwi, comes in second place. They have not raised interest rates yet. Nobody else besides Australia has, and they're currently at, 2.5%. Now, the U.S. dollar is still near the 0 to 0.25% rate. Now, if we have the choice, Aussie dollar is a very interesting pair to talk about, because if we have 10,000 units of currency, whether it's dollars or Aussies, whatever it may be, we want to invest our capital into a savings account. Would I rather place my capital in a U.S. savings account where current federal funds rates are just basically 0, or where federal funds rates in Reserve Bank of Australia are 4.5%? Obviously, the choice is to get a higher interest rate at 4.5%. That's why, and that's called the carry trade, by the way. You hear a lot about carry trade all the time. Carry trade is just a difference between interest rates. Over time, if we take away all other fundamental and technical events, capital tends to move into those currencies with a higher interest rate. If we had no other piece of news for the rest of the year, capital would tend to move into Australia as number 1, New Zealand number 2, and probably the dollar and the Japanese yen in last place. Now, because we have such a varying degree of interest rates, well, this is actually not so much. Look where interest rates were in New Zealand going back to 2008, above 8%. Look at the Japanese yen at 0.5% interest rate. You buy the Kiwi yen at 8%, or at 8.25%, I believe is what the rate was. Now, you buy the Kiwi yen, you receive 8.25%, you're liable to pay half of it back, 0.5% back, so you keep the difference. Divided by 360 some odd trading days a year, you make 7.5% or 7.75% return on your money for doing nothing. But you actually make more than that, because if you buy the Kiwi yen and I buy the Kiwi yen, eventually the chart starts to move and we start to make money on that actual investment, not just the interest rate. Now, when we talk about the Kiwi yen, or to a lesser degree the Aussie dollar, the foreign exchange market looks at these currencies in terms of risk versus reward. How much can I lose if I buy an Australian dollar? Well, they can cut rates a lot. They can cut rates from 4.5% down to 0. How much can I lose if I buy the US dollar with current rates almost at 0? Well, the most I can lose is only 1/4 point. The Bank of Japan has set interest rates at 0.1%, a tenth of an interest rate. How much can that central bank cut interest rates? The Bank of Japan can only cut it another 0.1%. The US can only cut 0.25%. The Reserve Bank of Australia can cut 4.5 percentage points, or 450 basis points. So when things look scary, when the stock market goes down, when we have bad news, maybe the GDP numbers in a couple of minutes will be bad news. The question that we all ask ourselves is, let's get out of anything risky. Risky is anything where we run the risk of that central bank cutting rates if the worldwide economy collapses. Reserve Bank of Australia, with 4.5%, carries the greatest risk. No pun intended with a carry trade. However, if things look good, I don't want to keep my money in a U.S. savings account, earn almost nothing, or keep it in a Japanese savings account, earn even less. I want to put my money at risk. Hey, if it's 1999 and every single tech stock is going up, or it's the year 2006 and every single housing stock is going up, everybody's making money, I have a little bit more risk appetite. I want to make some money too. So we're going to invest in higher yielding, higher risk currencies, like the Aussie and the Kiwi. If you're wondering is the Aussie the highest, well, it's the highest only the 8 currencies that we follow. You know, the dollar, the yen, the CAD, the Aussie, Kiwi, etc. However, if you really want to take some risk and the economy looks strong and you want to look at some even higher interest rate yielding currencies, you take a look at the third world third world currencies that are not within the G8. We talk about the G20, the G30, the top 30. That could include the Mexican peso, the Brazilian real, or the Argentinian peso, and a lot of others. Those have much higher risk, but also much higher yield. Meaning you want to buy those higher yielding currencies when the economy is strong. I wouldn't say anything right now, though. Things do not look very like we have a lot of risk appetite at this moment. However, to answer your question, or to address the Aussie dollar, if the number is good in the U.S., I think the Aussie dollar is going to go up. Because if the number is good in the U.S., the GDP number, which we expect in 4 minutes, if that's good, I think the Aussie dollar is going to go up because the worldwide perception is, hey, the U.S. GDP number is good, where everybody's making a little bit of money. I want to make some money too. Let me take some risk. Let me buy some Aussie. Even though the number was good in the U.S. Now, the U.S. dollar might actually go up on its own merit because maybe some of us will start to think the Federal Reserve will raise rates. You know, the foreign exchange market is really such a wonderful market. There's so many different angles we can look at this. So what could be one of the better trades in going long the Aussie dollar? Maybe the Aussie yen, because Japanese yen has even lower interest rates, and we know the Bank of Japan likes to keep interest rates low because it's an export-driven economy. So if the number is better than expected, if the GDP numbers are a really pleasant surprise, I would expect to see Aussie yen go up, Kiwi yen go up. Forget about the euro because there's too many other issues going on in terms of the euro right now. It's not a clear-cut answer. CAD yen, because the Canadian dollar doesn't have a high yield, but it is a commodity-driven currency. A lot of oil comes from Canada. So what's good for the U.S. economy is good for the price of oil. After all, a strong economy, consumer oil. We're going to buy oil. That'll benefit the Canadian dollar, and it goes on and on. Now, I hope I answered your question. Gold is making daily lows before the GDP data. What is the range for gold today? Like a look at the chart. And then I have some other really fun stuff to show you. I have a lot of fun stuff, and I do not have enough time. Okay, so refresh the charts here. And here we go. This is the price of gold on a future 1207.50, hitting high today of 1218.30. But we're almost at the bottom of the range for today, the daily candlestick, daily chart. All-time high for gold, adjusted for inflation, 1249.30. Those are the highs of May 14th. Kind of looks like a little bit of a head and shoulders too. What is the relationship of gold? Well, when we get really scared, when there's debt crisis out there, or some sort of geopolitical event that occurs, we see gold usually take off to the upside. However, aside from that, I think that's why gold has been so strong. We attribute a lot of the gold strength to Europe and the overall fear that we've been experiencing. However, aside from that, gold tends to go up with the anticipation of inflation. Because if the economy is strong and we can afford more commodities, we might buy some gold. But aside from that, if the economy is strong, things are going to get more expensive. And as things get more expensive, our dollars or our euros, whatever currency we have, that loses a little bit of value because, I have $100 in my pocket, but $100 right now in a weak economy can buy a lot. I get a lot of discounts out there. But if the economy is strong, $100 doesn't buy so much. Therefore, if we think or if we see inflation coming right around the corner, if we expect the economy to improve, gold will go up because traders buy gold to hedge their dollars, which tend to lose a little bit of their value. We have a few minutes before the GDP number. Oh, we have less than 1 minute. The expectation, by the way, is 3.5%, I believe. Let's take a look. If whoever has the answer, I don't have my Bloomberg Radio on right now, so whoever has the number fast, please do not hesitate to type it in. I believe the expectation is 3.5%. CNBC, they're usually very, very fast. Okay. The following chart, and this is a GDP number released on a quarter-over-quarter basis. The following chart, the blue line is a US GDP, gross domestic product. The violet line represents a 12-month moving average of that line. This is released on a quarterly basis. However, we do have a preliminary, a middle, and a final release. This is the middle one, I believe. However, with that said, we can see the 12-month moving average, and this is assuming the estimate 3%, 460,000 job openings. That, ladies and gentlemen, is a disappointment, and I'll show you why. We're going to take a look at some articles. I believe, okay, last quarter, the consensus was 3.2%. If I'm not mistaken, and I'm going to verify this in a moment, if not mistaken, the estimate was for 3.6%. So that is certainly a disappointment. Those jobless claims did not help either. By the way, thank you very much, Harley, and Tom, and Gang, whoever typed it in fast enough. We'll all have lightning fast fingers. Okay, let us get to the charts. Jobless sounds, that jobless number does not sound very good either. I have to check the data to make sure. However, taking a look at this chart, we see the number is at 3%. That is a disappointment. The 12-month moving average for that GDP number is above where we are now, meaning where the GDP number is lower than we would expect it than the expectation. Again, it was 3% versus, well, 3.2 was the previous result. Let's take a look at a Bloomberg.com article really quickly. I want to show you what they had, the estimates were. Actually, take a look at this. This is the daily FX economic calendar. Right over here, GDP. The previous release was 3.2%. You're correct. The estimate for today was 3.5%. We were expecting an improvement. It was not an improvement. It was a disappointment, and it was lower than the previous release. That is not good news. Now, what does that mean for us? Going back, we see the GDP, well, we did hit very, very nice highs, quarter over quarter, up at 5.6%. This is March of 2010. However, we have been declining ever since. In fact, until we break above those 5.6% levels, then we would look at levels we haven't seen since January of 2004, but that certainly has not been the case now. So the GDP number, certainly a disappointment, and we're also below our 12-month moving average, which is the violet line, and that is not good either. This shows us that certainly the current trend is very much to the downside in the GDP. Now, that means that the economy is not as strong as we once thought. Now, let's take a look at some other charts to compare this, or see the relationship, I should say. The violet line is US GDP, again released at 3%. That was a disappointment. The blue line is the Dow Jones Industrial Average cash market closing on a monthly basis. So we have not, right now the Dow Jones Industrial Average on my chart indicates 11,000. Certainly we're below 11,000. At the end of the month, I update these charts. However, notice the overall correlation. When GDP rises, that's the violet line. Look at GDP all the way up at 8% in the year 2000. Dow Jones Industrial Average, 1999, 11,497. And then we turned the corner. GDP came all the way down to negative 1.3% in June of 2001. Not too good. Dow Jones Industrial Average eventually hit lows of 75.91 going down to September. GDP then started to recover. GDP had a really nice move, moving up to 2003 high to 6.9%. These numbers, of course, can be skewed to a degree. The Dow Jones Industrial Average eventually made new highs. What's actually very interesting is notice how much GDP fell before the Dow Jones Industrial Average fell. I mean, if GDP was at 5.4%, gross domestic product was at 5.4%, when the Dow was at 11,000, wouldn't it be safe to assume that if the Dow goes to 14,000, shouldn't GDP must be a lot higher? GDP actually fell. Early warning sign that there was trouble ahead. Take a look at how far down the gross domestic product went to a negative 6.4 May of 2009. There's a strong positive correlation. When the economy is strong, we see the Dow Jones Industrial Average go up, and that is also reflecting the GDP number. When the economy is weak, both tend to go down. Take a look at the following chart. The violet line is the gross domestic product, again at 3%. The blue line is the dollar Swissy currency pair. When the economy is strong, the GDP numbers improve. The Federal Reserve says, hey, the economy is strong. Let's raise interest rates. The economy is heating up. Well, the expectation of higher interest rates, that tends to lead the dollar Swissy or other dollar crosses as well, tend to lead the dollar to go up. Because right now, if I can buy a dollar, I know I'm not really going to get any interest. But what if I were to forecast that maybe a year from now, I'm going to make 1% or 2%? Well, if I wait till a year from now to buy the dollar, it's too late. I would have missed the move. Market's a forward-looking mechanism. So you always want to try to guess the next step. So if the GDP number's good, we would expect the dollar to go up. GDP is bad, dollar goes down. Take a look at the peaks in the dollar Swissy, up at 179, 180. This goes back to 2001. GDP was very, very high also. As the economy fell, the Federal Reserve cut rates because, in part, the GDP fell. The dollar Swissy also fell as well. Dollar's been very strong lately. Maybe this will be the beginning of a turn for the dollar to the downside. Take a look at the following chart. This is my favorite one. Let me refresh the chart just to make sure everybody can see. Now, a lot of information here. The red line is gross domestic product, GDP. The blue line is our unemployment rate. It has a negative or inverse or opposite correlation. Unemployment rate, anybody know where we are right now? 9.9%. The red line, there's a little color code key at the bottom as well. However, the red line represents gross domestic product, what we just saw just a few minutes ago. The blue line represents U.S. unemployment rate. Currently, U.S. unemployment rate 9.9%. Currently, GDP numbers now fell to 3%. Right on the button, 9.9%, you're correct. Take a look at the violet line. Those are U.S. interest rates at 0 to, why put down 0.25%? Because if it was at 0, you couldn't see the line on the chart. So I put 0.25%. There is an inverse or opposite correlation between the red line, GDP, and the blue line, unemployment. When the economy is strong, GDP goes up. When the economy is strong, unemployment falls. Lately, the economy has not been so good. Well, GDP has fallen a lot. Unemployment rose. But what happened here? Take a look at how GDP recovered, but unemployment didn't. Let's when we have a lot of people in the room, I'd like to know what you think. How can we explain that the gross domestic product, which measures all the products and services, all the capital, all the money that is produced inside the U.S., why is it that the GDP has recovered so much from a negative 6.4, going back to June of 2009, even to current levels of 3%, still it's a lot better than what we were. I mean, I'd like to see it continue to go up. But why has GDP improved so much, whereas unemployment has not fallen? Wouldn't it make sense that when unemployment was up at 10%, Paul, what you said, was exactly what I was thinking. When the GDP rose, we would expect unemployment to fall. Why are we not seeing so many new jobs created? Obviously, the jobless claims is a perfect example of that, but GDP rises. One could attribute to the major stimulus packages that have been instated. That these stimulus packages that save a lot of people. Now, I don't want to interject my own political opinion. I don't think politics really has a very important role in terms of the pure trading of the market, but it's important to understand the implications. However, if I were to step on that soapbox for a moment, I would say that, well, maybe the stimulus plans benefited the economy in the sense that it saved General Motors, AIG, maybe because these other banks, for example, that received stimulus money, maybe that helped as well. But yet, it did not create so many new jobs. And still, a lot of jobs were lost. Maybe jobs is a lagging indicator. Maybe it takes a lot longer. They always say that jobs are always the last to come back, right? In order for us to get hired, to get jobs, so the company has to want to hire us. The company has to want to hire us if they're making money. They're making money if they're selling products and services. Well, if they're making products and services and they're selling that would be reflected in GDP. So maybe there's a little bit of a delayed effect. Let's take a look at this. GDP hit highs going up to 8% September of 2000. Unemployment actually about the same period of time. But the GDP looks like it fell a lot faster than unemployment started to rise. maybe the GDP moves a little bit before the unemployment rates move. Take a look at the FOMC, by the way. That's the violet line. That's the federal funds rate, currently just above 0% right now. As the economy is strong, the Federal Reserve says, hey, the economy is strong. Let's raise interest rates. And the violet line goes up. When the economy weakens, interest rates go down as the GDP falls. So, if you were to ask me, do I think the Federal Reserve will raise interest rates? Well, I would say I want to see unemployment fall. Well, we haven't seen that yet. We're 9.9%. I'd like to see GDP rise. Well, we have off the bottoms, but today certainly isn't a huge vote of confidence. And I want to see CPI and PPI, consumer price index, and producer price index, those inflationary numbers. I want to see those continue to rise. Because after all, the Federal Reserve is not going to raise rates until inflation returns to the picture. Take a look, by the way, if you were wondering, I happen to have it, easy access. This is the consumer price index. That's the blue line. And the violet line is the 12-month moving average. That measures, I should say, the basket of goods or services on the consumer level. How much we all pay for a cell phone and a loaf of bread and everything else. That's how much consumers pay. The next chart, I love these charts, is the PPI, the producer price index, which measures that same basket of goods or services before the consumer buys it on the producer level. It's very widely thought that if the producer price index, the PPI, goes up, the producers are paying more to make that stuff, that they're going to pass on those extra costs to us, and the consumer price index, the CPI, will go up as well. Well, so far, the CPI and the PPI are both dropping. So can we make a case that the Federal Reserve will raise interest rates? Well, PPI is falling, CPI is falling. That's not good. I'm sorry. There's a chart again. Should see the chart now. Please let me know if you don't. US PPI shows us the latest results, according to my records, fell to a negative 0.1%. So I would certainly happen to agree with you that PPI is dropping, CPI is dropping, GDP now, as of today, is dropping. The unemployment rate is not dropping. Not a big case to raise interest rates. Maybe the US dollar is going to go down. Let's take one more look at our economic charts. Then we're going to get to our price charts because we don't get those either. This is my favorite chart, though. Going back to this chart one more time. So we can see GDP is falling. Unemployment still near the highs. Federal Reserve, probably not a big case to raise interest rates soon. Why has the dollar been so strong? Let's go to the charts. Going to the charts now, let's pick a good currency pair. What do we say? We said the Aussie dollar could be a nice candidate to watch. Why? Because it's a very clear way to see the reaction of the market, because not only does it contain the US dollar, but it also shows us a comparison between high yield and low yield. If this number was better than expected, I want to take some risk because I think we're going to recover. If the number is worse than expected, which it was, then I want to run to the hills and run to safety. And that means buy or lower yielding currencies. In fact, taking a look at the 5-minute chart, what we oftentimes do is plot our 15-minute cooling off period strategy. I'll show you how it works really quickly here. This red line, this red candlestick, I should say, represents 8:30 a.m. Eastern, exactly the moment the GDP number was released. What I want to do is count forward 3 5-minute candlesticks. Some of you may be familiar with this strategy. It's a very easy strategy to apply to big economic events. Count forward 3 5-minute candlesticks. First one is the 8:30 to 8:35, 8:35 to 8:40, and the current candlestick 8:40 to 8:45. This candlestick will close in less than 60 seconds. Once it closes, draw a horizontal line at the top and at the bottom, the highest high and the lowest low the market was able to achieve during the 15 minutes, during the 3 5-minute candlestick. Delete that line. Okay. So the highest high we've seen so far in the Aussie dollar between 8:30 to 8:45, now the candlestick closed, was in fact 83.86. That's our top line, horizontal line. The lowest low was the previous candlestick. We hit a low of 83.59. The difference is what, 27 pips. It's not a big spread. Sometimes we like to see a larger spread than that. Usually around 40 to 50 pips. We like to see a generous market reaction. However, the strategy, essentially what it does is it forces us to wait 15 minutes. We call it the cooling off period strategy because we like to wait for cooler heads to prevail. After a big number is released, like the GDP, there's a lot of trades that are placed. The market goes up, the market goes down, and it's not very conducive to where the market could go in the near-term future. So what we want to do is wait for the first 15 minutes to pass and say, okay, all the nervous traders, you can place your trades. I don't want to. I want to wait for at least 15 minutes and wait for cooler heads to prevail. That means we wait for the first 5-minute candlestick to close. We mark off the highs and the lows, and we say the high, this is as high as the market went. And the low, this is as low as the market went. And if the market now is able to break above the high or break below the low, that break would then be that much more indicative of a real trend to the upside or a real breakdown to the downside. Technically, what am I looking for? I'm waiting for 3 more 5-minute candlesticks to close above resistance, or 3 more 5-minute candlesticks to close below support. Resistance 83.86, support 83.59. But like I said before, we generally want to see 30, 40, 50 pip range from low to high. 83.59 to 83.86 is not that good. That's about, what, 27 pips. That's not too hot. We can take a look at some other currency pairs, like, let's say, the dollar Swissy. That seems to be an obvious choice for many reasons. Dollar Swissy might be a candidate, actually. 830, the lowest low, that was 830, was 115.47. And the highest high that we were able to achieve 115.91. 47 to 91 is how much? It's 53, 54 pip range. That is good. So if the dollar Swissy, and we'll round it up to the large round figures, if the dollar Swissy is able to break above 116, I think we could certainly go a lot higher. If we break below 115.50, we could probably go lower. Question is, does it matter how long it takes to have 3 candlesticks close? The answer is yes. The more time, the better. CAD is really dollar CAD 55 pips? Wow. The more time, the better. Meaning, if the dollar Swissy, for example, breaks above our range right now and the next candlestick goes to new highs, how many traders were able to analyze the information, place a trade, actually press a button and make a decision and get involved in the trade in 15 minutes? Well, there's a lot of traders in the world, but certainly not a lot as a percentage. However, if it takes several hours or even a day for that to occur, let's say the dollar Swissy stays in the trading range for the next 20 hours, there's a lot more traders that are going to have a stake in the market. So if eventually the dollar Swissy, if we take 20 hours, sometimes it does take that long, to consolidate and then eventually break out, there's that much more people, traders, that have a stake in a trade. The trade has a greater likelihood, I think, of continuing. If we break out now, I hope it doesn't. I like it for terrains. In fact, the best trades using the strategy I found have occurred non-farm payrolls, which occur on a Friday, 8:30 a.m. Eastern on Friday, first Friday of the month, and then the market does nothing for the rest of the day, and the market does not break out until Sunday afternoon of the following week. Those trades usually turn out to be really, really nice home runs. If we break out immediately or within the next hour or so, I don't like to trade as much. To summarize, covered a lot. US GDP numbers released, 3%. The previous number was 3.2%, so it was a disappointment from the last quarter. And the consensus was a 3.5%, so it certainly is a disappointment from the estimate. Jobless claims seem to be kind of high as well. And this is certainly not conducive if we take into consideration recently dropping PPI and CPI numbers, unemployment rate, staying near its highs. Is conducive that maybe the Federal Reserve is not ready to raise rates yet. Not a big surprise probably to most of us. And this would probably, I would suppose, lead to some weakness in the Dow Jones Special Average and probably not a lot of strength in the higher yielding currencies like the Aussie and the Kiwi, because bad news tends to scare capital out of riskier currencies like the Aussie and the Kiwi.
Question is, if the market keeps ranging for a few hours, can we apply the strategy to hourly candles instead of 5-minute candlesticks? Well, I suppose you can. I always apply the 5-minute candlesticks, but maintain those horizontal lines at the original levels. Meaning that if you draw the horizontal line on the chart, just make sure that you don't move the line. You can wait for a 1-hour candlestick to close above resistance or below support. That'd probably give you actually a little bit more information, a little bit more confirmation. With that said, though, I'm out of time. If you want to contact me directly, though, please feel free. You may do so at www.forexfinance.com. I want to thank you all very, very much for joining us. I had a really good time today. Please see FX Street's calendar because we have much more later on. We're going to be covering a whole series of these economic numbers, including the GDP and non-farm payroll numbers, including these charts, and much, much more. And a very special thanks to FX Street for hosting these wonderful webinars. Again, contact me if you have any questions, comments, concerns. I want to thank you all very much for joining us. Wish you a great day, pleasant weekend, all profitable trades, and we look forward to seeing you.